sure you have a strong knowledge base and top-notch skills. Are you ready to take the bold step to invest in yourself? CFA Society Nigeria is at your disposal, promoting the highest standards of investment practice in Nigeria. As an affiliate of CFA Institute, CFA Society Nigeria seeks to promote the highest standards of investment practice in Nigeria and to provide a vibrant community in which its members and other key players in the investment industry can interact and grow. When you have a CFA charter, you're globally recognized. Take advantage today by writing the CFA exam and joining us at CFA Society Nigeria. For more information, visit us at cfasocietyn.org. CFA Society Nigeria, making finance a force for good.
Hi, Wale, you're muted. Okay.
Hello?
Yeah, hi, Cheryl. Good morning. We'll make you close in a minute. You're welcome.
Okay. Okay. Thank you. Sorry, I didn't hear what you said. You said something before. You're welcome.
I said we'll make you co-host in a minute.
Okay.
Yes, we do that in case the room gets rowdy. We'll stop allowing people to unmute themselves, but you continue to have that access.
Okay.
I believe we can start.
Okay, sure.
Okay. Am I clear now? Sorry. Okay. Good morning, everyone. This gives us great pleasure to.
While we can hear you, go on. Okay.
Cool. Good morning, everyone. It gives me great pleasure to welcome you to the Valuation Bootcamp for the CFA Society Nigeria 2022-2023 Nigerian Universities Research Challenge. So what we've done this year, different from prior years, is to organize training sessions for each team on the various aspects of the research challenge. Today, we're pleased to have a very distinguished personality to deliver a session on valuations. In arriving at the investment recommendation for the research report, you typically have to do a valuation on the subject company, and what the speaker is going to do today is walk us through key ideas and concepts that we can introduce in our valuation aspect for the research competition. The speaker today is a highly experienced individual. His name is Oluwaseun Onosoya. He's a CFA charter holder. He currently works in the deal advisory unit of KPMG Nigeria. So he's well experienced in the area in which he's an experienced professional with experience in investment banking, corporate banking, and most aspects of finance that involve valuations. And so we think he's someone who is more than capable of delivering a strong session today. We hope you enjoy it. So what I'll do next is hand over to him, and he'll present. I think the format we would like to keep, just to ensure everything is orderly, is he will walk through the presentation, at the end of which we can take Q&A. You can always use the chat box to drop any questions you have, so that we don't forget, or we keep track of them over time. Thank you very much for joining us today again. All right, so I'll hand over the stage to Sean.
Okay, thank you, Wale, and thank you to the society for the opportunity to come and take this session today. So good morning, everyone. So just to briefly introduce myself again, my name is Oluwaseun Onosoya. I'm currently a senior associate in the deal advisory unit at KPMG Nigeria, where we offer, amongst a bunch of other services, valuation advisory services to a number of clients across the country. And within the deal advisory units, there are subgroups that handle certain lines of business. So I'm part of the valuation subgroup in the deal advisory unit. Other than that, I have some experience in corporate banking at GT Bank, where I also did some valuations there, but not traditional business valuation, more liquidation related valuations, credit related valuations. And outside of that, I've also worked in management consulting briefly. All right, just before we go on and share my screen, I just want to confirm that everybody can hear me clearly. Can everyone hear me clearly?
Yes, we can.
Yes.
Okay, good. So let me share my screen. Please let me know when you can see.
Yes, we can see.
Okay. I just put it in full screen mode. Okay, so before.
You want
Sorry.
to use this? Okay.
Was someone saying something? Okay, I heard something. Okay. So I think someone is trying to say something.
No, go ahead, please.
Okay. Okay, so the topic or the session that I've been asked to today is an introduction to valuation. So this is just an introductory discussion on the key concepts that underpin the practice of valuation and the key things to look out for. It won't be, because of time, it will not be so technical and in-depth, but I mean, based on this session, I believe that you should be able to confidently carry out most valuations. Okay, so before we go into the presentation, I would just like to crave your indulgence to please participate. The session is for you and not for me. It is best when people participate because everybody learns better in that situation. Okay, so to start, are there people in this room who are familiar with valuations? Maybe they've conducted evaluation before or anything like that. I would like one person who is familiar to just share their experience.
They can raise
Is
their
there
hand
anyone?
or I'll mute them. They can unmute themselves right now if they want to answer. You can just unmute
Yes.
yourself.
Yeah.
All right. Good morning, sir. My name is Daniel Abi, and I have a little idea of what valuation is. And I think valuation is about getting the value of a company, of what it actually means in the present time and what it could mean in the future time. And doing valuation, you could actually use two methods. Basically, you could go through absolute valuation method or the intrinsic, and you can also use the relative valuation method by comparing it to its peers.
All right. Thank you very much, Daniel. That was nice. Is there anyone else? Just one more person.
Good morning, everyone. My name is Emmanuel.
Morning.
I think I have got a kind of what this valuation is all about. I think valuation has to do with the process of determining the value to which an asset is, probably for the sake of disposal.
Okay.
That's what I think about valuation.
Okay. Thank you very much, Daniel. Yeah. So Daniel and Emmanuel are both correct. Valuation is primarily used to, as the name implies, determine the value of an asset or a business for the purpose of making an investment decision. Okay. So let me go into the presentation now. Okay. So this is just a brief, description of what we'll be looking at today. So we'll try to understand what valuation is, why it's important. We'll try to understand where valuation comes from, why context matters, Then we'll look at the three major valuation methodologies. We'll talk about the presentation of valuation output, and then at the end, we'll take any questions or comments. Okay, so to start with, in order to understand valuation, I mean, if you want to undertake evaluation for the first time, your starting point is you need to understand what value means. So a thorough understanding of valuation always begins with an understanding of what value is supposed to mean. So at the most basic level, value means the worth, the importance, or the usefulness of something, just anything, any asset, any business, anything that is worth something and is useful to somebody is of value to the person. So I mean, taking this definition and applying it to valuation, then I mean it becomes intuitive that valuation is just the process of determining the worth or usefulness of something. Now, due to as used from the definition, is very broad. It's not particularly specific, and that's just the nature of the definition, and that's just the nature of the definition of value. So due to the broad and ambiguous nature of that definition, it can mean different things to different people in different contexts and different situations. So coming in finance proper now, valuation is synonymous typically with cash profits. And there's a reason why valuation has become synonymous with cash profits. Three reasons mainly. First off, the profit motive of business. So almost every business, although if you're in the news these days, you hear discussions. Okay, I hear that my slides are not changing. Is this true for everybody?
Yes, sir.
Yes.
So where can you see understanding valuation?
We're just seeing introduction to valuation.
Still on the intro. Wow.
Yeah.
Okay. Let me see if I can change my connection.
Yeah, we can see now, sir.
Oh, okay. I guess it's lagging. Let me just change it to faster connection. See if that will work. Okay, so can everyone hear me and see my slides?
Yes.
Yes.
So it's on understand. It should be on understanding valuation for everyone. Is that correct?
Yes.
Okay. Yeah, so I was saying that valuation in finance is synonymous with cash profits. It's due to three reasons. First of the profit motive of business. I was saying that although these days, if you're in the news or if you read the news or follow the news a lot, you'll see that there are some small discussions arising about whether the ultimate motive for the existence of business should be profit. But by and large, for nearly every business that exists, and the ultimate driving motive is to make profit. And because that's just the way humans are wired. The second reason why value is synonymous with cash profit is the tangibility of cash versus accounting profit. So, if for something to be worth anything to you, at least there needs to be some tangible way that it is improving your life. And in finance, tangibility is cash. So, I want to assume that you guys are familiar with financial statements. The profit that you see on the income statement is not always the amount of cash profit that the business received in the year, due to a number of non-cash items that will typically appear on the income statement. So, in order to assess true value of a business or an asset to someone, it needs to be cash. And the third reason is the objectivity of cash flow compared to other measures of value. Again, it's just, tangibility. Almost everybody agrees that if a business or a venture gives you more cash than you put into it, it has clearly demonstrated its value. So it's not something that many people can argue. So these are the three reasons why value is synonymous with cash profits. So why is valuation important? Okay, so there are four reasons. The first reason and the most important reason is valuation gives business leaders a good basis to make critical business decisions. So if a business wants to buy or to sell or to invest, you know, it would be very difficult for a business leader to make that decision without a preliminary understanding first of what the value of the investment is, or the business or the investment decision is to the company. So that's a very, very important reason why businesses undertake valuations. The second reason is it plays quite an important role in regulatory circles, such as in tax situations. So, for example, for wealth taxes, where a business will apply a tax rate to the overall wealth of maybe a person, it's very critical to determine the value first of the assets of the person in order to be able to determine how much you expect to receive as tax. And this is very important because this is a major driver of income for the government. And it is that income that the government uses to, carry out services that the population need. So, valuation is quite important in that regard. Third reason is that valuation can provide a solid basis on which to, okay, so I see someone has raised their hand. Adamu, go ahead.
Adamu, you can unmute yourself, please.
Yes.
Please, the slide is still not moving very well.
Still not moving?
Yes, please. It's still on understanding valuation.
Wow.
Hello, sir.
Yeah.
Yes, your slide is not showing on the screen.
Still not showing?
Yes, the importance.
It's still on why is valuation important. You can't see the...
Yes,
is this true for everybody?
It's still on understanding valuation.
Still on understanding valuation. And this is the same for everyone?
Yes, sir.
Yes, it's still on understanding. It just moved now.
It's like when I come out of presentation mode, it shows for everybody. Maybe I should stay, but I'll just increase the zoom.
It's showing now. It's showing.
It's showing. Okay, let me move to the next one. Can you see the slide I'm on now? Valuation process.
Yes, we can.
So you can see it now, right?
Yes, sir.
Yes, sir.
I guess it's a slide view situation. Okay, that's fine. We'll stay like this. Okay, so so the third reason is that valuation provides a solid basis on which to settle negotiations and disputes in a fair manner. So in typical M&A situations, typically the buyer and the seller will have their own ideas of how much maybe the asset in question that needs to be sold or the business in question is worth. And a good basis on which to begin those negotiations is to have an independent party conduct evaluation, so that at least everybody is clear on the basis on which negotiations can begin. So it provides clarity in a lot of M&A transactions and disputes. And then the fourth reason is that valuations are crucial to long-term estate planning. So when you want to, if you want to plan your retirement properly, you need to have a good idea of how much you will need at the time of retirement to be able to keep yourself and to sustain yourself. To keep yourself and sustain yourself till you die. Okay. So I'm on valuation process now. Can everyone see it?
Yes, we can.
Okay. Okay, so valuation is quite simple. It's just 3 steps. Understand, value, and present. And for understand, it's just the first thing you need to do is to understand the value drivers of whatever asset is being valued, and to understand the context in which the valuation is to be conducted. Then you can now go to the valuation process, the actual valuation, where you conduct the valuation using the appropriate methodologies And of course, as you are conducting your valuation, you are sense checking along the way, making any adjustments where necessary. And then at the end, you present the output of the valuation exercise in the correct manner. You know, there is a particular way that valuation outputs need to be presented for it to be reasonable and make sense to the consumer. So we'll go through that as well. And of course, at every step along the way, you are reviewing what you are doing and you are making improvements. So that's the valuation process in, I guess, in detail. Okay, so where does value come from? I think the first place to start, if you want to understand value, is consider, just a simple business. So let's say, I guess, a bottled water business or a sachet water business, what we call pure water. What would be needed to set up that kind of business? The first thing is, obviously, the objective would be, you want to make profits, as we have already discussed. So you want to generate enough money that it exceeds how much it costs you to set up the business, and at least you have enough money left over to live life. So to be able to generate those profits, the profits don't just fall from the sky, they need to be produced. And what generates profits in every business is what we call assets. So if you are accountants or if you are familiar with the accounting definition of what an asset is, you will know that an asset is a resource from which there is reasonable expectation of future profits in the future. Profits to be generated in the future. So it's the same thing, every business, if you want to have any hope of covering your costs, you need to have assets in place. But the thing is that these assets are not free. They come with a price because, like we already mentioned, everybody is in this for profit. So you have to purchase the assets from somewhere. And of course, as you are purchasing, you have to purchase the assets from somewhere. Let's start with that. So, to meet the price, you need funding to purchase the assets. So funding comes primarily from two sources, equity or debt. And sometimes there's a combination of both in what is called mezzanine financing. So things like preferred equity, forms of funding that have features of both debt and equity. So collectively, these sources of funding are referred to as capital. So you need capital to purchase the assets that will generate the profits for you. And of course, this capital, regardless of where it's coming from, will always come at a cost. Even if it's from your pocket, there is a cost to the capital that is being infused into every business. So, putting all this together, it becomes self-intuitive to understand where value comes from for every business. Value is created when the returns generated from a business's assets exceed the cost of capital provided to set up the business. In every business, there are primarily two sources of value. The first is the business model. So how the business makes money. Which customers are they selling to? What is their sales strategy? How many customers do they have? How many channels do they sell through? How many countries are they in? What are their products? What's the nature of the products? Things like that. That's what covers the business model. And then the second source of value typically is the operating model. So how efficiently the business is run. How cost efficient is the operations of the business, things like that. So those are the two primary sources of value for every business. Okay, so moving on, I mentioned at the evaluation process stage that context is quite important. At the beginning of every evaluation process, it's very critical to understand the context in which the valuation of whatever assets it is to be done. So we just want to briefly go into why context actually matters. And the reason why context matters is because there's more than one definition of value. We already mentioned at the beginning that, value is the original definition of value is very broad and ambiguous, which means, there's room for different interpretations. So in finance, you will see that there are several definitions of value depending on who you ask and depending on the situation you are in. But I've just chosen four here the four that are quite popular, just to illustrate how broad this value this term value can be. So the first is intrinsic value. I think it was Daniel that mentioned intrinsic value when he was talking about the methodologies used in valuation. Intrinsic value is the value of an asset when you have a complete understanding of its characteristics. So it's often taken to be the true value of the asset, and it's typically the best available estimate of an asset's value. And the second is the fair value. So this is the definition of value that is popular with accountants. So the amount for which an asset can be exchanged in a transaction between two knowledgeable and willing parties. The third popular definition of value is investment value. The value of an asset to an investor, taking into consideration the investor's specific consideration. So, it's different from fair value, because fair value is supposed to be an objective estimate of value. But depending on which investor it is, there might be additional considerations that may alter that investor's definition of value. Then there's liquidation value. So the value of a business if it were to be dissolved with all of its assets sold off. It's popular in situations of financial distress. So when a business is not able to cover its capital payments, so maybe the business has borrowed and it's not able to pay back due to cash generation issues. So as you can see, it's quite important to understand the context, because it is context that determines the form of value that applies in your specific valuation situation. Without an understanding of context, pretty much everything else you want to do in valuation is lost. So it's very, very important. Okay, so let's go on to the valuation methodologies. In valuation, there are generally three broad approaches to valuing a business or an asset. And there's the income approach, where you value, you conduct a valuation based on the present value of future cash flows. This is, I'm sure this is one that almost everybody is familiar with. It's a very popular, the DCF approach. Then market approach, valuation based on the value of comparable assets in the market. This is also quite popular in Nigeria, and it's even more popular abroad. Multiples valuation or relative valuation. And then there's the asset approach, which is a little less popular. It's valuation based on the accounting book value of the company, so the net assets of the company, as displayed in the financial statements. So we'll go into each of these three in more detail, starting with the income approach. Can everybody see where I am before I start?
Yes, sir.
So everybody is on income approach, right?
Yes,
Yes.
Okay. Okay, so let's go into the income approach then. So the income approach takes the value of the asset, as I've just said, to be the sum of the present value of the future cash flows. So it's also known as the discounted cash flow approach. It essentially involves estimating the future periodic cash flows for an asset, and then discounting these cash flows at a discount rate and summing the discounted cash flows together to arrive at a value estimate. So the income approach is considered the foundational approach in valuation. Is the approach that is most in keeping with the fundamentals of finance and accounting, and it typically yields a value estimate considered to be the closest estimate to the intrinsic value of an asset. It is not the intrinsic value of the asset, because it's impossible to know the true intrinsic value of the asset, but typically it's considered to be the closest of all the approaches. So it's important to keep that in mind. Okay, so let's go into the segmentation of the income approaches, because there are a number of approaches under this income approach. Depending on who you ask, there are different ways to segment the approaches under the income approach. Some people segment it. There's just different ways depending on who you ask. But I like to segment income approaches based on the perspective of the decision maker. So what do I mean by that? Using this approach, I guess, to segment, you will find two broad segments under the income approach. There's minority perspective approach and the majority perspective approach. So minority perspective approaches are income valuations conducted from the perspective of the minority owner in the business. So here, with these approaches, the appropriate discount rate is the cost of equity, and the appropriate cash flow measure is the post-decision equity cash flow. What do I mean by post-decision equity cash flow? When a business generates profit every year, so when they generate their net income, the shareholders, I mean, this is typically how every business is run. So the board and management of the business will sit down together at the end of the year and take a decision on what to do with the profits that have been generated. So typically this is what is called the plowback decision. So they decide whether to reinvest those profits in the business, maybe to continue to grow the business if they've seen tangible growth opportunities, or I mean, if the business is mature enough, they can take a decision to pay out those profits as dividends to the shareholder, given that, you know, there's no, maybe in the absence of tangible growth opportunities, it's pointless, you know, investing in money-losing ventures. It's just better to give the money back to the shareholders. Now, for that plowback decision, in the process of taking the plowback decision, it is typically the majority shareholders that have the most say over what the final outcome of that decision-making process will be. So, you know, for the minority shareholder, they don't have as much control because boards work on a majority basis. So whoever has the majority typically wins out. So for a minority shareholder in a business, value is only realized after the plowback decision has been taken. So, and because they don't have any control over the plowback decision process, you cannot say that a minority shareholder has seen value until that plowback decision has been taken. So that's the meaning of post-decision equity cash flow. Okay, so under the minority perspective approaches, there are two approaches. The first is the dividend discount model that estimates the value of a business to be the present value of future dividends. So it is most appropriate, actually it's only appropriate for companies with a consistent track record of paying dividends. So I've seen a lot of instances where people use DDM for companies who pay dividends from time to time intermittently. This is not an appropriate approach in those situations because, you know, the lack of a consistent track record will affect, you know, one of the key assumptions of DDM is that the business will continue to pay dividends perpetually into the future. And if the business does not have a consistent track record of paying dividends right now, there is no guarantee that that consistency will be established in the future. So the business has to have a consistent track record of paying dividends. So typically, this is used for mature companies. So your oil majors, for example, or maybe some banks, you know, these entities that are regular dividend payers, and this would be appropriate for them. Second approach is the residual income model. So it's used in situations where in all the other situations where companies do not pay a dividend, and typically in valuation cycles, the residual income is typically seen as a crude estimate of dividends for companies that don't pay dividends. So those are for the minority approaches. For the majority perspective approaches, these are approaches conducted from the perspective of the majority shareholder in a business. The appropriate cash flow measure here is free cash flow. So there are two income-based majority perspective approaches. The first is FCFF approach, free cash flow to the firm. It's typically used to estimate the value of the firm to all providers of capital. So, you know, and when we're talking about where value comes from, we mentioned that there are two primary sources of capital, debt and equity. So the free cash flow to the firm is an estimate of the cash flow available to meet the return requirements of debt and equity holders, shareholders in the business. And the appropriate discount rates to discount periodic FCFF is weighted average cost of capital, WACC. We'll go into the calculation of WACC later on. Free cash flow to equity is the second approach, FCFE. It's used to estimate the value of the firm to a majority equity shareholder. So, you know, we've looked at the minority approaches, those estimate the value of a firm to a minority shareholder. And this is an approach that estimates the value of the firm to a majority equity shareholder, the FCFA approach. It's known as the pre-decision equity cash flow. So here, I mean, as we've already discussed, when the plowback in the course of taking the plowback decision, in the course of taking the plowback decision, the majority shareholders typically have more of a say as compared to the minority shareholder. So when the net income is first generated, it first of all flows to the majority shareholders, and then it's up to them to take a decision on whether to pass it across to pass some of it across as dividend to minority shareholders, or to plow it back in the business and continue to grow the business. So I mean, it's a true definition of value to a majority equity shareholder. And the discount rate that is used here is also the cost of equity, because this is valuing from the perspective of an equity shareholder. Okay, so this is just I guess, a diagram of what we've just talked about now. So the income approach divided into majority perspective and minority perspective approaches, with two sub-approaches under each of them. Okay, so let's move on. Now, we just want to go into more detail on, the cash flow measures for each of the approaches and the discount rate measures for each of their approaches, how to calculate them. So starting with the minority and perspective approaches, for dividends, formula for dividends is typically net income multiplied by the dividend payout ratio. The dividend payout ratio is the historical proportion of dividends paid to net income generated for a business. So typically, in a dividend discount model, one of the critical assumptions is, so you look back maybe over 3, 4, or 5 years, how much dividends of the net income generated, how much has typically been paid out as dividends. And this is what you typically assume to be the dividend payout ratio going forward, unless the business has given you, or the decision makers in the business have given you any indication that this dividend payout ratio will change. For residual income, the formula is net income minus equity charge. So equity charge is essentially, it's a way to, what will I say now? It's a way to reward the equity shareholders in the business every year, because net income does not include a charge to equity shareholders. In the waterfall for net income, debt shareholders have already been taken care of in interest expense, but the equity shareholders have not yet been taken care of. So this is just a way to estimate, to take care of the shareholders in the business, just as debt shareholders have been taken care of on the interest expense side. Then for the majority perspective approaches, free cash flow to the firm is estimated as the after-tax operating cash flow minus the capital expenditure. The after-tax operating cash flow is after-tax earnings before interest, taxes, depreciation, and amortization, plus the non-cash tax shield. So when depreciation, amortization, any non-cash losses, they reduce your taxable income on the income statement. So they provide a tax shield to a business, because they lower the taxable income that the business pays in the year. They lower the taxable income on which the tax rate is applied in the year. So you have to add that back, because you are trying to estimate after-tax operating cash flow, which excludes interest. And interest as well comes with a tax shield component. So you have to isolate and remove that tax shield component, which is why we add back the non-cash tax shield for non-cash charges on the income statement. And then you subtract the changes in working capital. So on the balance sheet, I know in accounting, the traditional definition of working capital is current assets minus current liabilities. But when you are estimating the value of a business under the DCF approach, the focus is typically on core working capital items. And so the core working capital items for a business are receivables, payables, and inventory. So typically those are the balance sheet line items on which we focus when we are computing changes in working capital under free cash flow approaches. Then for free cash flow to equity, it's a more expanded formula. So the formula is after-tax operating cash flow minus capital expenditure minus after-tax interest plus net borrowing. So, I mentioned that we have to adjust for the tax implications of interest, the tax sensitivity of interest expense. So when you adjust for it at the beginning, when you are calculating your after-tax operating cash flow, you have to subtract it again when you are calculating free cash flow to equity, because the after-tax operating cash flow excludes the effects of interest expense. And net borrowing is just the proceeds from borrowing minus the borrowing repayment. So the change in principal. So if let's say you have 100 million naira loan and you pay back 20 million in the year, so your net borrowing then would be negative 20 million because it's a cash outflow. You are paying back 20 million. So 20 million in cash is leaving you to the debt holder or the provider of debt for the business. Then we move on to the discount rate. So the discount rate reflects the minimum return required by the typical provider of capital to invest in a business. It reflects the riskiness of the market relative to other assets in the market. So that minimum return that a typical capital provider will request for, it will reflect the riskiness of your business or the business that is being valued relative to other assets in the market, such as government bonds, real estate, any other type of investment, because all investments exist in a universe. So, I mean, in investing in your business, the capital provider is incurring opportunity cost because he could have put the money anywhere else, but he has decided to put it in your business. So that opportunity cost has to be compensated. So, and typically when any debt holder or equity holder is trying to invest in a business, their return requirements will typically account for that opportunity cost. So there are two discount rate measures for free cash or for DCF approaches. The first is cost of equity, KE. It's the minimum return required by the typical shareholder. It's appropriate for discounting cash flows applicable to shareholders only, as we've discussed. The weighted average cost of capital is the weighted average required return from all providers of capital. It's appropriate for discounting cash flows applicable to all providers of capital, as we've seen. Free cash flow to the firm approaches. Okay, so let's go into the derivation of each of these discount rate measures. The first is cost of equity. The cost of equity is typically estimated using the capital asset pricing model, although there are other ways to estimate the cost of equity, but this is by far the most popular and most intuitive way to estimate it. So the CAPM is equal to the risk-free rate plus the beta adjusted market risk premium. So let's go into the meaning of each of these components. The first is the risk-free rate. The risk-free rate is the rate at which the most creditworthy entity can borrow in an economy. So typically in every economy, the most creditworthy entity is generally assumed to be the government, the central government of the country, although it's not always the case, but it's typically assumed to be the central government because, I mean, it's assumed that they can never default on loans that are issued in their own currency. Although, I mean, we've seen that governments can default on foreign currency loans, but for local currency issued loans, I mean, there's no way they can do. All they just need to do is print more money because they have control of the mint. So that is the assumption behind the concept of central governments being the most creditworthy entities in any economy. So the risk rate is typically estimated as the yield on a government bond with a maturity that matches the horizon of the cash flow forecast underpinning the valuation model. So take, for example, let's say, I mean, most DCFs will typically not go beyond 5 years as a forecast horizon due to the high degree of uncertainty in forecast beyond 5 years. But I mean, you will see some valuations that are 10 years, some that are even 20, 30 years for finite life valuations. So valuations of businesses or assets in extractive industries, such as, mining, oil and gas, where, the primary source of value has a finite life. So maybe the oil field or the mining field or, the mines where the mineral is extracted. So those can go into, those will be as long as the estimated life of the value driver will be. But yeah, so let's stick with a 10-year model, for example. In a 10-year model, the risk-free rate, the appropriate risk-free rate to use in your cost of equity estimation should be the 10-year yield. So the yield on a 10-year government bond. If there is no 10-year government bond in place, then the closest, so the government bond with the closest maturity to 10 years should be used as the reference government bond on which you extract your yield estimate. Okay, so the next component is beta. So beta just means it's a way to measure or to estimate the level of business risk inherent in an asset or a business. And it's estimated as the expected percentage change in a company's share price when the return on the market portfolio changes by 1%. So it's just the sensitivity of a business's shares to the market portfolio, so to the broader stock market. The output is typically a coefficient. So it's a coefficient with decimals. And if the coefficient is above 1, it means that the business carries more risk than the broader market. If the coefficient is below 1, it means that the business is less riskier than the broader market. And it's primarily used to, customize the discount rate estimate to reflect the specific risk characteristics of the business or the asset being valued. So if you go back to the cost of equity formula, you'll see that, there's really nearly all of the components here are broad measures. They are general measures that are not specific to the business. So the risk-free rate, for example, is not specific to the business, and neither is the market risk premium, as we will see. So the only way to customize this discount rate estimate to make it specific and reflect the risk characteristics of the specific business is to use the beta, the beta coefficient. So that's why it's very important in every cost of equity estimate and every discount rate estimate. For non-listed companies, so for a listed company, it's very easy. You just if you have the historical returns for the shares of that business, you compare it to the historical returns on the broader market, and you do a covariance. So you perform a covariance of the returns, the daily returns or the monthly returns, whatever, the periodic returns of the shares of that business to the periodic returns on the broader market. So let's say, for example, now you wanted to value a business listed on the Nigerian Stock Exchange. So you might go and get historical returns for 1 year, or historical changes in historical share prices for 1 year or 2 years, however long you want the period to be. And then you have that on one end, and then you have the historical returns for the NSE ASI, so the all share index. You have that on the other end. And then you calculate the covariance between the two price pools that you have in order to determine the beta coefficient. Covariance is a complex formula, but because of time, I've just decided not to go into more detail about it. But typically you won't need to compute the beta yourself. There are many sources from which you can get beta, and the most popular one is Capital IQ or Bloomberg or Reuters. All these finance data aggregation services have estimates of beta that you can always use. But it's still good to understand it on a fundamental level, to understand what beta means on the fundamental level and why it's important in valuation. Okay, then the market risk premium. So the market risk premium is the equity risk premium plus the country risk premium. The equity risk premium is the additional return over the risk-free rate required by a rational equity investor in a mature liquid market. The country risk premium is the premium demanded for additional risk exposures over equity risk. So typically in the, I guess in the risk rankings or in the risk hierarchy, equity is typically considered to be riskier than debt, which is considered to be riskier than, government debt. So equity will always carry an additional risk over debt because of the variability in returns. With debt, the return level is already set via the interest rate. If I give you a loan today, I charge you an interest of 7%, I already know well ahead of time what my return will be on that investment. But it's not the same for equity holders. So if you purchase today the stocks of maybe MTN or Dangote, there's no guarantee, there's no guarantee ahead of time as to what the percentage return level will be in 1 year's time or in 2 years' time or 3 years' time. And that variability means that there is greater risk. It could yield 20% return for you, or it could go to zero. There's no 100% sure way to know what the return level will be in a year's time as compared with a 1 year loan, for example, a loan with a tenor of 1 year. So that's why there's an additional risk premium that is attached to equities. And then country risk premium. So, because the capital asset pricing model is a model that is built from the perspective of an investor in a mature market. So mature markets are G7 countries, really, the US, Germany, UK, and Japan in particular. These are countries where, much of the financial plumbing for the global economy flows through. So, the most widely used currencies are the dollar and the euro. So really, nearly all business investment decisions and nearly all investment activity is concentrated in this country. So it's from the perspective of an investor in those markets. If that investor wants to invest in markets outside of, the mature markets, they will require an additional risk premium because, I guess the infrastructure and the protections that they are accorded in their countries are not always accorded in other countries. So there's a heightened risk of loss, even if your equity investment returns 50%, there is still a theoretical possibility that you might not be able to realize that return for whatever reason. Maybe, if you are not able to convert your earnings into your local currency because of exchange rate restrictions. It might be that maybe the government just declares one day that all assets are nationalized, all businesses are nationalized, and unfortunately your equity investment is caught up in that, and your theoretical returns have been lost. So just things like that, situations like that, the way that mature market investors try to, I guess, provide for that is to attach an additional risk premium to the equity risk premium. So for mature markets, the market risk premium is just equal to the equity risk premium, as I've already explained. Because in mature markets, they are afforded certain financial and legal protections that are not present in all the other markets or in most of the other markets. But for non-mature markets, the RC, the country risk premium will be a non-zero number. And so the market risk premium will then be the equity risk premium plus the country risk premium. Country risk premium is typically estimated as the spread in the yields between the government bond of a country and an identical government bond from a mature market. As what Damodaran, he typically is the source for risk premium estimates in valuation circles. These are, so he updates, or he typically publishes an estimate of country risk premiums for quite a number of countries in the world twice every year. So typically this is what most valuation or most valuers or valuation practices use as their country risk premium estimating valuations. Well, I mean, if you have the data to estimate the country risk premium on your own, that is typically preferred than relying on someone else's estimate. But I mean, most people don't have that data, so we just rely on it. Okay, so moving on to the weighted average cost of capital. WACC is the weighted average cost of equity plus the weighted average cost of after-tax debt plus the weighted average cost of preferred shares. So, as we already explained, it is the estimate of the cost to all providers of capital, so cost of acquiring capital from various providers, that is adjusted by the proportions of each of their funding in the general capital structure. So, for example, let's say you have total capital of 1 million. 50% of that capital came from equity shareholders and 50% came from the debt shareholder. So the weightings here would be 50% for the cost of equity, 50% for the cost of debt, 0% for preferred shares, because there are no preferred equity providers in my example. So typically this is another pitfall that a lot of valuers make, particularly in this part of the world. And they typically use the capital structure weights based on what you see on the balance sheets in the financial statements, the book value. But this is not the appropriate way to calculate the weighted average cost of capital. In valuation and in the estimate of discount rates, and really in most things, most estimates, they have to come from the market. So they have to be market-related estimates as opposed to accounting-related estimates. So, and it's the same thing that applies for weighted average cost of capital. Your capital structure weightings have to be market-based. So they need to be based on the computation of the market value from all funding sources. If the company that you are valuing is not listed, you can use the average market-derived capital structure for comparable mature publicly listed companies as a proxy for the long-term market capital structure for the company. But it is not appropriate to use the book value capital structure weighting to compute WACC. Okay, so the last component to talk about under the income approach is terminal value, which is, in my view, the most important component in a DCF valuation, because it typically constitutes about 65 to 75% of the value of a company using the DCF approach. So, I mean, most businesses are considered to be going concerns long into the future. And because, your valuation, you cannot estimate the future cash flows of a business forever, because, there's just nobody knows the end for infinity and things like that. So, and because, as I've already mentioned, there is a significant amount of uncertainty beyond 5 years when you are making cash flow forecasts. So typically, you want to always cut short your cash flow forecast at around 5 to 10 years, unless, as I explained earlier, you're valuing maybe a business in the extractive industries or things like that, businesses where the value drivers have finite lives. So if you use a typical 5 to 10 year discounted cash flow model, the business will continue to exist after those 5 to 10 years, and they will continue to either generate or destroy value long beyond the horizon of your cash flow forecast. So you need to account for that. And the best way to account for it, and the way it is accounted for in the income approach, is terminal value. Second thing is that, the terminal value is based on what is called the steady state assumption. So in the steady state, the business is typically assumed to have reached full maturity and, with all sources of outsized growth fully explored. So what that means is the assumption for terminal value is that at the point at which you want to start calculating terminal value, all of the subsequent cash flows are cash flows that reflect a business that have exhausted all growth opportunities and really is not doing any more investments beyond the investments to maintain the existing state of the assets. So the company is not plowing back money to drive you know, outside maybe double-digit growth anymore because all those sources have been exhausted because the market has been totally saturated. So that is a key assumption when computing terminal value. It's typically estimated using the Gordon growth model. The Gordon growth model estimates terminal value as the final year or the final period cash flow in your valuation model, grown by the long-term growth rate, and then divided by the weighted average cost of capital minus the long-term growth rate. And the long-term growth rate in valuation is typically estimated to be either long-term inflation or the long-term nominal GDP of the country in which the business operates. I typically prefer to use the long-term nominal GDP of the country because inflation can be very, as you know, as we can see these days, that inflation can be very flimsy. You know, one day is 2%, and before you know it, it's almost reaching double digits everywhere. So inflation to me doesn't reflect the true long-term growth rate for a business. I feel like nominal GDP is a lot more, long-term nominal GDP is a lot more stable than long-term inflation. Okay, so let's go into the pros and cons of the income approach. The pros, first of all, is very flexible and adaptable. It can incorporate just about any assumption that you want to make. Very extremely flexible. There's always a way to fit it into your cash flow forecast and your discount rates. It's extremely robust. As I mentioned, you know, it's rooted in fundamentals. It's extremely detailed. So, you know, and typically it's what is used by professional valuation practices, including us. It's the approach that is preferred by professional practices because clients cannot argue with the robustness of the model. And obviously it's fundamentally sound. So it's rooted in accounting and finance fundamentals. The cons are that it's extremely sensitive to inputs. So garbage in, garbage out. If the inputs are faulty, then your valuation output from a income approach would be very faulty as well. And it's very prone to manipulation because it's so flexible and it's so robust. There are many, many ways that, you know, a valuer can manipulate the output to fit his or her perspective. And it's also very time consuming and technical to prepare. So, I mean, it requires you to first of all analyze the historical financial statements of a business. Then you have to prepare a cash flow model. Then you have to prepare a discount rate model. So it takes quite a lot of time. And this is time that many people might not have. So that's a con for this. Okay, so moving on to the market approach. Market approach essentially is an approach to valuation that is, it values a business from the perspective of the market value of comparable businesses or assets. It's based on two key principles, and the first principle is the law of one price. So this says that all things being equal, an identical asset you trade for the same price everywhere, regardless. So if there is a shirt in Nigeria and a shirt in the US, all things being equal, it should be the exact same price. After you adjust for all of the, I guess, all of the peculiarities of both of the markets, the true price should be the same everywhere. So that's what the law of one price is. And the second principle is the wisdom of crowds. And it says that large groups of people are collectively smarter than individuals. Essentially says that regardless, no matter how smart you are, and if 90% of people believe that an asset is worth this price, they are more reliable than one person who believes that the asset is worth another price. And just the reason why this belief is quite prevalent is because, you know, as we already explained, the income approach is very, very technical to do and is very time consuming. So what a lot of traders in the market always assume is that to all the big asset managers, you know, the big investors would have already done their cash flow valuations and would have come up with an estimate. And, you know, because the big asset managers and the big investors are the ones who move the market, whatever they value a company at is what they will typically base their trading decisions on. So if the big investors and the big asset managers decide to trade at a particular price level, then it must mean that that is the true price level for the asset. So all other traders just follow that and they just decide to trade around that level. So typically, the largest asset managers and the largest investors are very, very powerful and very influential for this reason. Okay, so in order for your market approach to work, it's very, very important that your comparable companies have the same risk profile and be at the same stage of maturity to be truly considered comparable. If your list of comparable companies consists of businesses with different risk exposures to the business being valued, your comparable approach or your relative valuation will be off. So it's very important that these businesses have the same risk exposures and be at the same maturity stage. It is also a minority perspective approach because it values a company from the standpoint of the holder of the shares of a publicly traded company. It is a preferred approach when conducting short-term transactional and fair value valuation. So, I mean, if time is a very important constraint and you don't have the time to conduct a more fundamental DCF evaluation, you can just typically use the market approach to quickly come up with a value estimate on which to base your, I guess, transaction discussions around. Okay, so the market approach is based on ratios that are called multiples. So what are multiples? Multiples are ratios of long-term value estimates, such as enterprise value and equity value, to fundamental performance metrics, such as sales or EBITDA or net income, operating cash flow, free cash flow. So accounting-based performance metrics. And how the market approach works is that you take these multiples, you multiply them by the fundamental value measure, and you come up with your market value. Market approaches are divided into two categories. Enterprise value multiples, as I've mentioned, multiples aimed at determining the enterprise value of a business or an asset. What the enterprise value means is the estimate of value from the perspective of all providers of capital, so debt, equity, and mezzanine funding providers. An equity value is just the value of an asset or a business from the perspective of an equity shareholder or an equity claim holder. So equity value multiples are multiples aimed at determining the value of a business or an asset, as I just mentioned. So this is where you have the popular multiples: price to earnings, price to book, price to sales, price to cash flow. For enterprise value multiples, enterprise value to EBITDA, enterprise value to EBIT. There are also some that are enterprise value to sales. Okay, so it's very important to note under this market approach that certain things need to be in place for your market approach to yield the correct value estimate. The numerators and denominators have to be on the same claim holder basis for the multiple to be meaningful. So your numerator, which is your long-term value estimate, and your fundamental performance metrics need to reflect the perspective from which the valuation is conducted. So for example, now, if you are conducting a valuation from the basis of all the providers of capital in the business, then your numerator must be the enterprise value, and your denominator must also be a performance metric that is relevant to all of the providers of capital in the business. So for example, earnings now, net income. Net income is not relevant to a provider of debt because all the debt provider cares about is that this interest must be paid. So the performance measure that is relevant to a debt provider must be an earnings measure that comes before interests are taken into account. So EBITDA or EBIT or operating income. So therefore, anybody you see using enterprise value to earnings multiple, the multiple is wrong and it's not meaningful. And the same thing goes for price to EBITDA. I've seen some people use this a lot. And again, it is not a meaningful multiple because there is a mismatch, there is a perspective mismatch between the numerator and the denominator. The second thing that you need to notice is that multiples need to be grounded in financial and statistical fundamentals to be meaningful. What I will go into more detail about what I mean as I go forward. So segmentation of market approach is divided into two. Comparable companies approach and precedent transactions approach. The comparable company approach values a business on the basis of the market values of comparable companies. The precedent transactions approach values a business on the basis of the implied market values in recently concluded transactions. Okay, so going into the key considerations, I mentioned that the multiples need to be grounded in financial and statistical fundamentals to be meaningful. So I want to go into a bit more detail on what I mean by that here. When you are trying to conduct evaluation using the market approach, there are some things that you need to take into consideration that are very important. The first one is what we've already discussed. Is the numerator and the denominator meaningful to the same sets of claim holders? We mentioned that already. Second thing is uniform estimation. Are the variables estimated in the exact same manner across all comparables firms and the subject of the valuation? So what do I mean by this? Is earnings calculated in the same way across all of your comparable companies and the business being valued? Different companies calculate net income in different ways. So if the calculation of net income is not the same across everybody, or if the calculation of EBITDA is not the same across everybody, maybe there are other non-cash charges that some people take into account when they are calculating EBITDA, while some others remove it. Your valuation, your relative valuation will be off. So you need to make sure when you are spooling your list of comparables that you check that the calculation of EBITDA, the calculation of earnings, the calculation of operating cash flow is the exact same for all the companies in your comparables or in your peer group. The third thing is statistical considerations. What is the average, median, and standard deviation for the multiple that you want to use? Are there is not available, or maybe the numerator is negative? How do you deal with those observations? Very important. Okay, say my internet connection is not stable. Can everybody hear me?
Yes, we can hear you.
Yes.
Okay. So for example, there's different views on how people deal with this. Some people will say, like in your peer group, only include companies that have meaningful multiples. So any company that has a negative multiple, exclude them from the peer group. There are other people that will say, do not exclude any observation at all, whether the multiple is negative or positive, whether the multiple is meaningful or not. Include all of the multiples in your peer group when you are doing your statistical adjustments. I tend to side with the second group because in statistics, when you adjust, financial data, let me start from there. Financial data is very different from other kinds of data. Financial data, first of all, is not uniform. It's not uniformly distributed like most other kinds of data. And financial data is very, very sensitive to outliers. So if you adjust a peer group, or if you adjust a set of financial data and remove all the negative observations, you are distorting the overall uniformity of that data set. And essentially, you are allowing for the positive outliers to exert more influence on your average and your median and your standard deviation calculation. So I am always of the perspective that no matter how many people in the peer group have negative multiple estimates, just leave the multiples. You have to take them all into consideration when you are calculating your average, your median, your standard deviation. Very important because of the influence of outliers. If you exclude the negative multiples, then you have to make further adjustments to to the peer group that you have chosen because of that influence of outliers. So typically, the adjustments people will make is they will calculate, of course, the average and the standard deviation, and then they exclude of all observations that are maybe certain standard deviations above the mean. So maybe 2 or 3 standard deviations above the mean, just to try and make sure that the comparables or the peer group data that you have is much more statistically uniform. The fourth thing is fundamental consideration. What are fundamentals that drive this multiple, and how do changes in these fundamentals change the multiple? So, it's very important. One of the observations or one of the assumptions that a lot of people make when they use this approach is that they fail to consider the fundamental drivers of the multiples. So, and it's very wrong, because even though these multiples appear to be very quick and easy, you just take a multiple, maybe 2 times EBITDA, and you just apply to the EBITDA and you get the value. But these multiples are still grounded in fundamentals. So for example, let's take price to earnings now. If you do the derivation of price to earnings, if you do the fundamental derivation, the proofing is beyond the scope of this discussion, but I mean, maybe for more detailed discussion, or maybe when you get into valuation in professional setting, I guess this will be introduced to you. So if you take price to earnings, for example, into consideration, when you do the proofing for price to earnings, or the mathematical derivation of price to earnings, you will see that there are certain fundamental drivers of a price to earnings multiple. So for example, long-term growth, the dividend payout ratio are very critical fundamental drivers of the price to earnings multiple. And and also the discount rate as well. The discount rate is also a very important fundamental driver. So, things like this are very important, and you have to take this into consideration when deciding on what multiple to use in your valuation. Okay, so pros and cons of the market approach. Again, pro is very intuitive and it's very easy to understand and use. Like as I've already mentioned, a lot of people use it. Second is based on publicly available information that is easy to find. It's based on it's based on stock market information that is generally available to most people. I know maybe in Nigeria now, the stock exchange data is not freely available, but in most other countries, this is information that is quite easy to find. And the third is that it's very, very popular, particularly amongst the high-level valuers. So, for example, a recent survey was done on Wall Street in the US, and the results found that 83% of investors use the market approach as the primary driver of their decision-making. And then 50% of people involved in M&A transactions base their final decision on the multiples valuation as opposed to a DCF valuation. So it's very, very, very popular. And this popularity continues to drive the adoption of the approach. The cons of the approach is influenced by short-term market conditions. We mentioned that it's the preferred approach when you are trying to conduct the valuation without having the luxury of time. So it's very influenced by short-term market conditions. It's pointless when there are no comparables, because comparables are not very easy to find. It's not easy to find an exact one-for-one comparable for Dangote, for example, or for MTN, or for Presco, or for Como Oil. It's not easy to find a one-for-one comparable. And then it's based on data that is recorded in the past. Valuations are supposed to be estimates of value based on future considerations. But, in using this approach, you are basing your future valuation estimate on information that is in the past. So, that there is sort of a mismatch there that people need to take into consideration when they use this approach. Okay, so let's go into the asset approach, which is the final approach. The asset approach is the approach that considers the value of a business to be the value of its assets less the value of its liabilities. It's also known as the cost approach method to valuing a business. There are two approaches under this approach. First is the liquidation approach. It's used in distress situations when a business is about to wind up or cease to be a going concern. At that point, there is no future considerations to take into account because the business will not be in existence again in the future. So all you are interested in at that point in time is what is the value that can be realized from the sale of the assets after the liabilities have been taken into account, so that all of the claim holders can be settled. So it's very popular in liquidation situations. It's also sometimes used to value going concerns as well. So, but the thing with using this approach is that the balance sheet records certain line items not on the basis of market. For example, inventory now. Inventory is recorded at cost. Which other line item again? You know, there are certain major asset line items, fixed assets, for example, as well, is recorded at cost. And this is fundamentally at odds with, you know, the principles of valuation, which require you to value a company based on market-derived estimates. So, you know, in order to be able to conduct a proper net asset valuation for a going concern, you would have to first of all determine the market value of fixed assets, the market value of inventory, all those things. And those things can take a lot of time. But typically, it's very common and it can be suitable to businesses where most of the assets are recorded at market or fair value. So, for example, financial services companies, banks in particular, where, you know, the primary asset on their balance sheet is loans. And loans are typically recorded at fair value or market value. So, you know, typically, you will see people who do a net asset approach for banks, for insurance companies, for commodity traders, for example, sometimes. But typically, I mean, I would not recommend using an asset approach for any business. You know, it's just not an approach that is very, I guess, in keeping with the principles of core valuation. Okay, so the pros and cons, I've already touched on some of these. It's intuitive and easy to understand and use. It's most appropriate in distress situations for the reasons I already explained. And it's suitable for companies where most of the assets are recognized at market value, as I explained. So financial services businesses. And the cons is very inappropriate for valuing going concerns because of the reasons I just mentioned. Major line items are recorded not at market value, but at cost. And also, you know, the balance sheet may not also take into consideration all of the assets. You know, there might be certain intangible assets, for example, that are not recorded on the balance sheet, but are very, very critical to the value of a business. So, I mean, using this approach, you will not be able to properly take them into consideration. It's also very difficult to properly identify and value certain assets on the balance sheet that I explained. So special use, PPE, intangible assets, things like that. And again, it's also very backward looking. You are valuing a business based on its future prospects, but you are using backward looking information that happened in the past. Again, there is a timing mismatch there that needs to be reconciled. Okay, so we move on to presentation of valuation outputs. Valuation outputs are estimates subject to significant uncertainty. So therefore, you have to make adjustments at the presentation stage to minimize the influence of these uncertainties on the integrity of your value estimates. So there are generally two ways that people use to achieve that effect. The first is to do a sensitivity analysis, and the second way is to do a triangulation. So, and also it's very important to remember that evaluation output can never be a point estimate. It can never be a single number. There is no single true value for a company. It always has to be a range because of the high degree of uncertainty associated or involved when you are conducting evaluations. You know, evaluations require you to look into the future and to estimate what the business is likely to look like in the future, and then bring those estimates back into the present to come up with a value estimate. There's a high degree of uncertainty because nobody knows tomorrow perfectly. So, you know, it's always not a good idea to have just one single number and call that a value estimate. And the appropriate output for evaluation exercise is evaluation range presented in evaluation summary. Okay, so for sensitivity analysis just is a process where you adjust one or more key evaluation parameters to assess the effects on the output of a model. So the output is a range of value estimates based on the adjustment of one or more key parameters, like the discount rate and the long-term growth rate, which are typically the two parameters considered to be the most sensitive to the value estimate that is arrived at. Very common, sensitivity analysis is very common with DCF valuation approaches due to the high amount of subjective parameters in DCF valuation that you have to keep track of. It's also common in instances where only one valuation approach can be used. So for example, when you're valuing a very highly specialized asset with no public market comparison, maybe you're valuing a state-owned company, for example, state-owned monopoly. You know, it's very difficult to find public market comparables for state-owned monopolies. So the only valuation approach you can use is an income-based valuation approach. And because of the high degree of uncertainty associated with income-based valuation approaches, it's imperative that you conduct a proper sensitivity analysis at the end of your valuation exercise. Triangulations are the approach used for most valuations. So in triangulations, you take into consideration one or more valuation approaches when you are estimating the value for a business or an asset. And it involves valuing a business or assets with different approaches. You estimate the value ranges from each approach, and you take a weighted average of the approaches considered to arrive at a final value range for the business or the asset. Yes, the most approach, as I mentioned, is the most popular approach to accounting for uncertainty in valuations, and it's grounded in statistical fundamentals. And it's typically recommended that when you can, try to use at least 3 valuation approaches to reduce the influence on uncertainty, the influence of uncertainty on your value estimates. Let me just show you what a valuation summary looks like. So here, this is assuming that a valuation has been conducted using 3 approaches. So one is a DCF approach or an income-based approach. Second is a comparable companies approach, and the third is a comparable transactions approach. So you list out, first of all, you come up with a high and low value based on each approach. And then you take a range. The reason why you take a percentage range for each of the valuation approaches is just to see the variability of your valuation estimates. So typically, you don't want, if your range is too far or is too wide, then there's probably a problem in the way you've conducted your valuation, and it's a sign that you should go and take a look at that valuation again to see if there's maybe any adjustments that you can make, or maybe there's any assumptions that have been made that are faulty. That's why we include the valuation ranges for each of the approaches. And then when you've brought in all the approaches, then you take the average of the high and the low from each approach. And then whatever the average is what you take as your value range. And that's what is presented to the client as a value estimate. Okay, so to close, there are certain golden rules that I believe every valuer or everybody who wants to become a good valuation person needs to take into account or needs to master and always consider. The first thing is you need to seek to understand first before you value. What do I mean by this? As I've already mentioned at the beginning, you have to take into consideration the context of the valuation exercise, the context in which the valuation is being carried out. You have to take into consideration the perspective of the decision maker or the investor. You also have to take into consideration the value drivers of the business or the asset. So you need to have thorough understandings of these 3 things before you even start the conduct of the valuation. The second golden rule is you need to embrace uncertainty in valuation. Valuation is as much an art as it is a science. So I mean, when the first time you do a proper valuation, you may be very tempted to think that valuation is a core science because of the numbers, all the numbers that are involved. But really, valuation actually is a discipline that requires just as much creativity as alignment with fundamentals. So no 2 valuations will ever be the same for a company. It will never be the same because every company has different peculiarities and different things that they do, which you have to take into consideration when you are conducting the valuation. For example, now, even 2 companies within the same industries. So, I was told that you guys are valuing Okomo Oil, or the company for which you are making an investment decision on is Okomo Oil PLC. So let's use that as an example. Okomo and Presco will never have the same value, regardless of the valuation approach, because they will do certain things differently, even though they are in the exact same industry and they are in the same country and they produce the same product. So it's very, very important that you allow flexibility when you are doing your valuations. And then the third golden rule is to stay rooted in the fundamentals. So never forget where value comes from. Value is, again, when the returns generated from your assets exceed the cost of the assets. regardless of the business, regardless of the year, now and 100 years into the future, value will be created in the exact same way. It doesn't matter the business model, even for internet businesses, even for tech businesses, value is created in the same way everywhere. So never forget that. And then be aware of the limitations of valuation approaches and always account for them. I think this, in my opinion, separates, the master valuers from the novices. The best value experts or the valuation experts are always the ones who have complete mastery of the limitations of each of the valuation approaches, and they are able to properly account for them in their valuations. I believe once you can master all of the limitations of each of the valuation approaches and properly incorporate them into your valuation estimates and into your valuation process, then I believe, you can say that you are a proper valuation expert. All right, that's the end of my presentation. Thank you. So are there any questions? Let me go into the charts. Does anyone have questions?
Thank you very much, Sheung, for the well-detailed presentation. Yeah, so there's a question here from Emmanuel. Emmanuel is asking, how do we get the market value of a company debt?
How do we get a market value of a company?
Debt.
I didn't hear the last part. Market value of a company?
Of a company's debt.
Oh, a company's debt. Okay. Yeah, good question.
Yes.
So, what is typically done? There is a fundamental way to derive a market value for a debt. Typically, we do not use, in Nigeria, yes, most valuation practices use the cost of the debt that is incurred on the company's balance sheet, but that's the wrong way to estimate a market value of debt. So typically, the value of debt is the risk-free rate plus a credit risk premium adjustment. That credit risk premium adjustment, how that credit risk premium adjustment is derived. So, credit rating companies, they will typically they will have credit ratings from maybe AA, AAA to C or D. And for every credit rating, they will have a credit risk premium attached to that credit rating. And that credit risk premium represents the adjustment or the extra premium over the yield on a government bond, for example. So typically, what you will do is you will estimate the credit rating of your business based on the credit rating parameters as provided by the credit rating. I think in Nigeria, we have some credit rating companies, Augusto, GCR, and there's, I think, one or two others. But I don't know if that information is publicly available. But typically, that's what will be done. That is the fundamental way to determine market value of debt. That's one way. The second way you can use is CBN every day publishes, not every day, but periodically, they publish what is called I've forgotten the name now. Prime, the prime lending rate. Yeah, that's exactly what it is. The prime lending rate, which is essentially the rate at which the most creditworthy corporate entity in Nigeria can borrow. They publish that regularly on their website. So you can go there and you can use the prime lending rate as a basis for at least a ground level estimate for your cost of debt before you can then adjust it for any credit risk premiums based on calculations of, or any considerations based on adjustments for credit risk that you see anyway. So that's the way that I would go about estimating the market value of debt. Does that satisfy you, Emmanuel?
Please feel free to unmute yourself, please.
Okay. So it says yes in the chat. All right, so any other questions?
Hi, Sean. Good morning.
Hi, morning.
Yeah, thank you very much for the insightful presentation. So I wanted to ask, my name is Shokwe Okuno. I want to ask, please, what's the importance of EBITDA in valuation? Like, EBITDA comes up almost everywhere. So what's like the grave importance to calculating EBITDA in all valuation practices? Thank you.
Okay, thanks. Okay, so the reason why EBITDA is very popular in valuation is because what valuers are looking for is a income statement estimate that is as close to cash as possible. At the beginning, I mentioned that in finance, valuation is synonymous with cash profits. So what a lot of valuation practitioners do is they try to look for an estimate on the income statement that is as close to cash as possible and represents, I guess, an earnings estimate that will be relevant to all the providers of capital in a business. And the earnings estimate that they have considered or they've all arrived at as being the most, I guess, relevant and the most logical is EBITDA. So earnings before interest, taxes, depreciation, and amortization. But again, remember that EBITDA, the use of EBITDA depends on the perspective from which you are conducting your valuation. If you are conducting your valuation from a minority perspective, so from a minority shareholder perspective, then EBITDA is not relevant to your valuation. EBITDA is only relevant if you are conducting valuation from an enterprise perspective. So from a perspective of all the providers of capital, if you want to determine the value of a business to when you take into consideration all the providers of capital, then yes, EBITDA is your estimate. But if you are valuing a business from a minority shareholder perspective and only considering the value of the business from the perspective of equity shareholders, then your value estimate, the earnings estimate that matters to you is net income or free cash flow to equity. Okay, Shokwe, is that okay?
Yeah, that's okay. Yeah, very well. Thank you very much.
Yeah, no
Thank
problem.
you.
Any other questions? Okay, no, sir. Go on. See, your hand is raised.
Yeah, thank you very much, Mr. Sheon. You made it look so easy. My observation is that looking at the fact that valuation is also an art vis-a-vis science,
yes.
To what extent can we hold valuers accountable in instances of window dressing?
Yeah, very good. Good question, a very important question. Ultimately, the only way to hold valuers accountable is to also have some, fundamental understanding of what valuation is and what drives value as well in the first place. Typically, what is exploited in practice is that, the business or business decision makers don't really have a good understanding of what valuation is. So they are not able to even detect when window dressing has been done. They are not able to detect when adjustments have been made, and they just take whatever the valuation practitioner gives them at face value and they run with it. So I think the only way to be able to call out a valuation practitioner on any suspected window dressing is to also have a good understanding yourself of what value is, where value comes from, and the places where valuations can be adjusted and manipulated. Sir, is that okay?
Yeah, that's okay. I think the point has been made. Thank you very much.
Yeah, no problem. Any other questions? Okay, so I see people asking for the slides. Definitely, I will send the slides through to the society so that you can have them and use them for reference. So yes, everybody will get the slides. Okay, any other questions? I guess there are no more questions. Okay, Wally, you can go on, Wally.
Okay, I'm just asking some questions that I think we usually get. Or I think something that I think students always ask is, so for
for what informs, I mean, DCF, you have different styles of DCF. You can either use a free cash flow to equity, free cash flow to debt. What markers would you say drive decisions as to which DCF approach you follow? Is it DC? Is it FCFE, FCFF? What things do you think that would you advise students to consider, or what things that can they observe that would lean them towards a free cash flow to equity or a free cash flow to the firm?
Okay, thank you. Okay, so I think the two drivers of which approach to use are, first of all, the perspective from which the evaluation is being conducted. I mentioned earlier that you can conduct evaluation from a majority owner perspective and also from a minority owner perspective. So if you are valuing a business from a minority shareholder perspective, the cash flow or the approach that you need to use is different. So it would be maybe a dividend discount or a residual income model, depending on the track record that the company has in paying dividends. If you are valuing from a majority shareholder perspective, then you have to consider the free cash flow approaches. Then, I mean, also, choosing between FCFF and FCFE also depends again on what matters to the majority shareholder. So if the majority shareholder wants to look at the business from a consolidated perspective before taking into account any provider of capital, then the preferred approach would be the FCFF approach. But if the majority shareholder is interested in the value of the business after debt providers have been taken care of, then the appropriate valuation approach to use is the FCFE approach. So again, what I would take into consideration is the perspective of the shareholder, the perspective from which the value is being conducted, and what matters to the decision maker. And I think you can get that from your discussions with management or with the clients. I saw a second hand being raised. It said 2 participants raised their hand. Shibuzo, you can go on.
Okay, good morning, sir.
Hi, morning.
My question goes like this. You talked about taking different consideration in calculating like people and their perspective at which we look at it to calculate. So I want to ask, is this perspective, is it peculiar to companies, or is there a general value? Because I know that I've seen, like, one of my previous valuation, I calculated EBITDA, and I realized that it was different from probably what other people calculated. On general, there are different perspectives that I've seen, but I want to know if there's a standard perspective that you can recommend, or that you feel that we are using that we should change, or something like that. I don't know if you got my question.
Yeah, I understand your question. So just a perspective that is typically common in valuation in professional settings. Okay, yeah. So I mean, the perspective that I've seen that is widely used typically is the free cash flow to the firm approach, FCFF. And that is because you typically a FCFF approach it produces a value estimate on which you can compare to. So I mean, it produces a common comparison basis for value from one company to the other, because it excludes the effect of any capital structure peculiarities from business to business. Businesses can be funded in different ways. Some people 100% equity, some people 90% equity, 90% debt. Different businesses can be funded in very different ways. And the ways that these businesses are funded can have a very significant effect on value. So one way to value a business on a common ground to other businesses, to nullify the effect of any capital structure influences, is typically to value the business on the enterprise value level, which you can do with a free cash flow to the firm valuation. So you'll see that most valuation practitioners in practice, if they have time, they will typically conduct a free cash flow valuation, free cash flow to the firm, FCFF valuation first, as their primary basis for decision making, and then they can now triangulate with other valuation approaches, maybe other enterprise value based market approaches, for example. So yeah. Sorry, Chibuzo, does that satisfy you?
Okay, not really. Okay, my question probably you don't understand. What I meant was, for instance, in calculating EBITDA.
Okay.
So if, for instance, okay, let me use let's say Zenith Bank.
Okay.
Is there a way that I can calculate my own EBITDA and someone that is also working on Zenith Bank calculates his own EBITDA and will get a different value? Does it mean that one of us is wrong using the same approach in calculating the EBITDA?
I mean, not necessarily. EBITDA is just earnings before interest, taxes, depreciation, and amortization. It's very possible for you to calculate EBITDA and for somebody else to calculate EBITDA, and you can get different estimates because there might be other non-cash charges that are above the operating income line that are being considered by one person that are not being considered by the other person. You know, in EBITDA only mentions two non-cash charges, depreciation and amortization, but there can be many, many more non-cash charges in the income statement above the operating income line that are considered. For example, foreign exchange gains and losses, restructuring costs, R&D development costs, research and development costs. So there are different non-cash charges that are also included above operating income that can be considered by one person and not considered by the other person. And that will be the results that will yield the difference in the EBITDA. So all that matters, I mean, there's no right or wrong EBITDA calculation way. It's just that you make sure that both of you are calculating EBITDA in the exact same manner. And that the way you are calculating EBITDA is the way that all of the companies that you are comparing that company to also calculate EBITDA, so that you have a common basis for comparison between the two companies or between your company that you are valuing and all other companies.
All right, thank you very much. That's clear.
No problem. Yusuf, you were about to say something.
Good morning. There is no need. I've gotten what I want to say.
Okay, no problem. So any other questions, or are we all happy? All right, so I guess I'll assume that there are no more questions. Thank you very much for having me today. I've enjoyed the session. I hope that you've also been able to, I guess, take one or two things from this. Thank you again for having me.
All right. Thank you, Sean, for this session. I don't know if everybody enjoyed it like I did. I think we should please give him a round of applause for taking time out on this weekend to walk us through a very interesting session on valuations. As always, if you have more questions, you can always send them through. We'll try and patch them and package them. The slides will be sent to everyone after this presentation. So don't worry about that. You will all get the slides. And we also recorded this session. So we'll have a link to the recorded session so that you can refer to this if you want to maybe remember a few things. Okay, all right. So thank you all for joining. I think it's almost 11. We plan to end by 11. So thank you, Sharon. Thank you to everyone, and I wish you a very good weekend.
Thank you.